Good evening, everyone. How are you?
Good, how are you?
Good. This is going to be interactive because otherwise you'll just fall asleep about 10 minutes in.
Yeah.
So, because if your mouth is moving, that means your brain's engaged, and that means you're not sleeping. So I do occasionally teach here too as an adjunct professor. So I do like to do this sort of thing. Let me ask you before we start. Show of hands. So I'm going to ask you to rate yourself in terms of knowledge of just taxes in general. So are you really good?
I'm like a negative.
Negative?
Yeah.
Okay. Sort of good? Basic? Yeah, okay. Scared? Yeah, scared? Okay, all right. Okay. So let's. I'm going to try to ease into this, and but before I do that, I have to put this disclaimer up here. If anyone takes anything I say today, essentially, and uses it on a tax return, I'm not accountable, because the tax code is somewhere around 100,000 pages long, so it's really complicated, and a lot of times it contradicts itself. And sometimes there's court cases you have to go to. So please don't try this at home. Okay. Very complicated. Okay, so when I say taxes, what do you think of?
That synonym with the taxes and debt, right? They don't wait. There's common saying like taxes and debt. It's inevitable.
Oh, it's inevitable, right? Yeah. Taxes and death are the only sure things in life. Yeah, that's true. Yeah. I think taxes are actually very old, right? Like almost in ancient times they had taxes, right? Actually, some of the earliest history is recorded on coins, which were used to pay taxes. So, in any case, let's go a little deeper. Let's have someone else. So, when I say taxes, how are they calculated? What do you think? Okay, percentage of income. That's one possibility, right? So I'm going to start writing your percentage of income. What other ways?
There's a lot of ways. Amortization, how much you're putting money back in R&D. Even if making profit, you need not pay income taxes because you're putting all the money in R&D or you're making some losses in other businesses. There are other ways of not paying taxes, if that's a question.
What about if you have a loss? What happens? Anybody?
Yeah, if you're lost, you don't pay taxes and you can defer it for next year or so.
So my response to this is maybe you can.
Maybe.
Maybe you can. Any input from here?
Sales would be something.
Okay.
Not income necessarily, but
Sales,
sales.
right. Okay. So in DuPage County, twice a year, what do you have to pay? Or they sometimes are escrowed for you. Property tax. Sales tax in there too. Has anyone ever bought a bottle of wine or a case of beer?
Oh, yeah.
Okay. There's special kind of taxes on those that the people who produce it. Does anyone know what those are called? Begins with an EX. Excise taxes. Okay. So my point is a broad subject, right? It's all over the place.
I used to work in travel business, and so you want to start talking about hotel taxes and paying for stadiums and things of that nature.
There you go. So with the 10 people or so in this room who admit they know nothing about taxes yet, right? So does that give everyone an idea of how broad this topic is? Okay. So in order to fit this within the time we have, we're going to narrow it down. But before we go, when do you think taxes are due?
When you
File? What else? We talked about property taxes. When are those due?
Oh, twice a year.
Twice a year, right? If you have your own business and you don't write yourself a paycheck, when do you think those taxes are due?
Quarterly.
There you go. So.
I guess they do know a little bit.
Yeah, there you go. All right. So common taxes that relate to business, income taxes. This is similar to what some of us said. It's essentially a percentage based on your income. Okay. Let's just sideline just a little bit. What is income? What's the word income mean in a business? Is it your revenue? Is it your cost? Is it something else? Anybody? When I say income, what if I said net income? What does that feel like to you? After tax. But what about before tax? You have your revenue. Do you get to keep all the revenue? If you sell something, right, you got to pay other people and you got to pay for products, right?
Right.
So what you keep is really less than your revenue, right?
Yeah.
So that's net income. So income taxes are a percentage of your income. Then there's employment taxes, right? So who here has ever had a W-2, right? And you see those two people, you see the guy called FICA, right? And you see SS, which is Social Security, and you see MED, which is Medicare, right? There's also self-employment tax, which is a special application of employment taxes. Okay? And as we talked about, someone mentioned sales and use taxes, property taxes, excise taxes, and there's probably quite a few more. Okay? So let's narrow this down. We're not going to focus on these. We're not going to focus on sales taxes, property taxes. Some states actually tax non-real estate, just like machinery and equipment. Illinois is what's called a replacement tax. And then excise tax we talked about, and alcohol, gasoline, and other things. Okay, so we're not going to talk about these, so get them out of your head. Okay. Not to say they're not important. We're just not going to talk about them. So we are going to talk about income taxes and employment taxes, and here's why. When you're self-employed, depending upon the type of entity you choose, and we're going to be going through some of those possibilities tonight, self-employment taxes, you essentially pay yourself a paycheck, right? So when you get a W-2, it's about 7.5%. Comes off your paycheck and goes to the Social Security and Medicare trust funds, if you think they actually exist, right? They're supposed to, but they don't really. But little you may not know is your employer pays the other half. They pay another 7.5%. So when you're self-employed, you have the distinct and high privilege of paying both sides, right? And that ends up being 15.3%. Okay. So and depending upon the entity you choose, which we'll go into in this presentation, you can sometimes pay that 15.3% on every single dollar of your income, or only on part of it. Okay, so you need to keep that dynamic in your mind, because income taxes and self-employment / payroll taxes, they sort of work together, and depending on what entity you choose, you can increase one and decrease the other, or decrease one and increase the other within certain boundaries. So that's why we can't talk about income taxes without self-employment taxes. The other thing I want to mention about employment taxes is, while they often have the same base, they are completely separate. So on the same dollar of income, you can pay both income tax and self-employment tax. So they're two different buckets of taxes. And it leads to some strange results. So here's an example. I have a client. The wife has a W-2 job. She works for somebody else. He has a business. His business lost a lot of money, right, in prior years. So he's got a loss. But this year, he made money. So they have zero income tax liability, but they have employment tax liability. So sometimes it ends up with very strange results.
So employment tax on the prior years or the only current year?
Current year. Current year.
Because they deferred the losses from the last 2 years to the current income.
Yes. But they're
Not
different.
retroactively.
Yeah, they're different buckets of income. Self-employment is a very special type of income, and it operates on its own basis. So another client I had, the husband's a teacher, the wife owns a couple of businesses. She owed self-employment tax. He paid it through his paycheck, right? So you can end up with really different results. So, but what I told them is, for every dollar that she makes, her tax liability is 34%. Because with her tax bracket, which was 22%, and the self-employment tax, you start adding it up, you start realizing that's 34%. So every dollar she makes, it tracks 34 cents of tax. On the other hand, his W-2 income was only 22%. Now he pays the FICA, right, and the employer is paying the other half. So again, we're going to go over this in a little more detail, but I just want you to get these concepts in your mind.
24% as a progressive tax or the straight tax? It's a 24%, but that's a progressive, right? 22 plus.
You have to take the employment tax plus the income tax. They're stacked on top of each other. In other words, one doesn't replace the other. They're separate, but they're on the same income.
But she must be 34% bracket, but she's not paying 34%, right?
No. So that person is in a 22% bracket, and you add the 15% of self-employment tax. That's how I got her to the 34%. Yeah. So that makes it very important to make sure you include all your deductions, because every dollar is worth a lot. All right. So let's segue a little bit into just income taxes. So income taxes are based on taxable income. So as we talked about before, revenue less deductions. So if you have $100,000 in revenue and $120,000 in expense, that's a loss. In some cases, you can actually get a refund. In other cases, you can't. Right? In some cases, you have to carry it forward. The government, the IRS, operates very much on this premise. If you have a loss, great, you don't pay any income tax, but you don't get any back. You have to wait till the next year to get that money back. Deductible expenses, what are deductible? So a lot of closely held businesses, I see a lot of things like, what's this for? Well, it was for my kid's birthday party. Well, guess what? You can't deduct that, right? Just because you own your own business doesn't mean you get to make up the rules of the tax code. They have to be ordinary and necessary. It's a very broad concept, but there's lots of case law on it. There are some definitions in the tax code, but think of it this way. If you're a business owner, if you had to pay for everything, which you do in a way, but if you had to pay for something in your business, does it make sense? Do you need it to run your business, right? If you don't need it to run your business, it's probably not ordinary and necessary. So, one of the things that really causes a lot of issues is automobile use. Just because you use a car in business doesn't mean you can deduct the whole amount, only the business use part. And that actually creates a lot of back and forth, a lot of questions, a lot of data requests back and forth between my clients and me, because those areas can get kind of complicated. So,
Sorry, with that, do you use the mileage? Like
you can.
Split it out between business and personal?
It effectively comes down to how many miles did you use for business, how much did you use for personal. Yeah, essentially. One way or the other, whether the company owns the car, whether you own the car, one way or the other, you can't deduct all the usage. It's only your business use. So, personal expense is not deductible. Okay. Now, there is a little bit of benefit you get from self-employment tax. So we talked about how when you're self-employed, you have the distinct and high privilege of paying both the employer and the employee portion of your taxes. So, as a concession, you get to deduct half on your tax return, okay, if you have what's called a sole proprietorship, which we'll go over in a second. So let's say you had a salary of $100,000, employment tax are $15,300. You get to deduct half of that $15,300 on your tax return.
So joint, I can use that one, right?
Yes. Yeah. Deductions do not include sales and use taxes. So I want to make sure I spend a couple minutes on this. Sales taxes are on the consumer, the purchaser. As a business owner, you're an agent of the government. So you need to record that in your revenue, nor do you deduct the cost. You're a pass-through. Okay. However, if you're supposed to charge sales tax and collect it, and you neither charge it nor collect it, you have to pay it. So you're liable for that tax. So if you just go, whoops, I didn't charge them sales tax, it comes out of your pocket. And the reason they do that is because they didn't, you know, it's just so let's think about that. Let's say I have a shop selling something, selling balloons and party supplies. And I go, well, let's see, if I don't charge sales tax and I can go to the government and say, oh, I forgot to charge it. And they go, that's okay. What are you going to do? You're not going to charge sales tax, right? Because the guy next door to you who's competing with you isn't going to charge it either, and it goes on and on and on. So that's why they have this rule in is, yeah, it's on the consumer, but if you don't collect it, you owe it. The business owes it. But if you charge it when you're supposed to and you remit it when you're supposed to, there's no effect on your income. Timing. Timing is really, really, really important in tax. Here's the most important reason. Personal income tax, and in some cases business income tax, is based on annual income. So January 1st to December 31st, unless you have a different tax year, right? Each year you start over. You start over at zero. Personal income tax rates we'll go over in a second, but they're graduated. I think I have this right. They've changed recently. Okay. So it's like a layer cake. So on the first, say, 10,000 of income, you get taxed at 10%. And let's say now you're up to 30,000, right? We'll have an example in a couple minutes. That next 20,000 is going to tax at the higher rate, and so on and so on. So when you're up here, every extra dollar you earn is going to be at the higher rate. So if you can shift legally, if you can shift deductions or income from one year to the next, you lower your overall tax liability you pay over time. So over your lifetime, or 10 years or 5 years, whatever the case may be, you can actually pay less in income tax with good tax planning. So that's why timing is really important. Like almost everything, right? Timing is everything. And that's also the case for the tax code. So again, the ability to defer or accelerate can make a difference in the total tax you pay. So, however, the government knows this, and they know people try to take advantage of it. So let me say this. The government has thought of every single loophole that you can ever think of. For every single person that figures out how to get around it, immediately, I'm talking within hours, the IRS will issue a regulation saying you can't do this. So a lot of clients I have, they think I have some magic wand, or they think, oh, I bet you they never thought of this. They have. And it's just going to get you and me in trouble. So the best way to optimize your tax position is with really good tax planning. Good tax planning happens before the year starts. There's very little you can do when you're in the tax year. Very little. And later on, what we'll do is we'll talk about the selection of tax entity. Once you start that, you're pretty much stuck with it. So it pays to think about, if you have a small business, how long you're going to be in business, how you're going to monetize it, when you're going to get out. Are you going to bequeath it? Are you going to expand it? Are you going to sell shares to other people? These are all really, really important questions that you need to try to answer when you're first starting. Because there's things that you can't undo. And once you're set and that train's rolling down the tracks, you can't get off at the stop anymore. There are ways around it, but it's sometimes more expensive to get around it than it is just to pay the tax. So I had a client tell me, the price for your return is too expensive, and I'm not going to pay it. And I said, well, I'm not going to do your return. And he said, well, then I expect, you to save me in taxes. I go, here's the thing, the tax year's over. I can't do anything about last year. There are some very, very small things you can do. They're very limited. But by and large, once the year's over, it's over. So just keep that in mind. The best time to plan your tax liabilities before the year starts. And actually, the really best time is to do it several years down the road.
And what about on consulting services? There's not a sales tax on that, right?
Generally, no, but it depends on the state.
Okay.
Most states do not tax services. Some do. Illinois has sort of this hybrid law where, say you're a repair person, and along with your repair services, you charge for parts. In some cases, those parts are taxable. In other cases, they're not. So Illinois has a very, very complicated sales and use tax. Here's the other thing about sales tax. So I'm just going to segue for 30 seconds because we don't want to focus on this. If you're a business and you buy things and when you sell them, there's tax due on them, if you use them for your own use, you have to pay the tax as if you sold it to yourself. That's called use tax. So that's something very important to keep in mind. All right. So let's talk a little bit about rates. So the rate you pay depends on whether the business is taxed as a pass-through or a C corporation. So let's first concentrate on C corporations because there's only one structure like a C corporation, that is a C corporation. Everything else in business is pretty much a pass-through, and I'll explain what that means in a minute. But a C corporation is a completely separate entity from its owners. It has its own tax, it has its own estimated tax, it has its own income, it has its own losses. It is a legal person, separate, completely separate from the shareholders. There's no crossover. The only crossover that can happen is if there's fewer than 5 shareholders in certain types of businesses. There is sort of a hybrid that comes into play. They're anti-abuse. So I was explaining earlier that the IRS has pretty much thought of everything. And so sometimes what happens is, and this happened decades ago, people got very creative. They said, well, if I buy property and then that's a certain type of income and there's only 5 of us, we'll split it up and we'll make a lot of money. IRS goes, these are all the rules except if you have less than 5 and accept this and accept this. For every rule there's an exception. For your purposes, it's completely separate and distinct. Okay. So as of January 1st, 2018, did everyone hear about the Tax Cuts and Job Act 2017? Okay. It was a pretty major overhaul. It was 1,000 pages long. Took a long time to get through it. And there is actually a summary that Congress publishes that puts it in sort of plain English, but not really. As of January 1st, 2018, C corporations have a 21% flat income tax. So that means from $1, if you make $1, you're going to pay 21 cents in tax. If you make $1 million, you're going to pay 21% times $1 million, which is $210,000. Yeah, you pay $210,000. It used to be graduated, but the curve was very steep. It didn't take long to get to the maximum rate. Okay. And we'll get into a comparison in a few minutes as to why we're here and why we're talking about this and why it's important. Dividends are taxable to the shareholders at personal rates. So you get taxed here and you get taxed here. Okay. Corporation pays 21% tax. The corporation is due that tax. Corporation writes the check. Corporation pays the IRS. If there's money left over, right, dividends. Has everyone heard of dividends? Right? What's a dividend? In short, layman's terms, what's a dividend?
Money paid back to the shareholders.
Exactly, right? Now, when you get that dividend, in most cases, it is taxed on a personal level. Some cases it's taxed at your regular income tax rate. Sometimes it's taxed at a lower rate called a capital gains rate. But the important point here for tonight, for this presentation, is you pay tax twice. And if you think back to employment taxes, you're actually paying it 3 times, right? The corporation is paying employment taxes. The employee is paying their part of Social Security and Medicare, right? So that's one level. The corporation is paying tax, and the individual who receives the dividend is paying tax again. Okay, so there are 3 levels. So there are strategies that we're going to touch on, just a few of them, about how to optimize this. But I just want you to understand with the C corporation structure, you're paying tax at 3 different junctures. Dividends are not deductible by the corporation, right? Because it would end up in this kind of circular algebraic conundrum. You dividend your after tax income, but if your dividends are deductible, then that's after tax, and then you just go in the circle and you never get to the answer. So dividends are not deductible. So as I said a few minutes ago, shareholders effectively pay income tax twice on the same income. So let's go over a very short example. You have a C corporation. Makes $100, so net income. So your revenue minus your deductions, $100 times 21%. The corporation writes a check to the IRS for $21. You're left with $79, right? 100 minus 79. If, so it doesn't have to be, which is a very important point, which will come up later. If the corporation decides to dividend out the 79, the shareholder owes tax on the 79, or shareholders, at their personal income tax rates. So a little earlier we talked about how personal income tax rates are graduated, right? The first dollar is taxed at a lower rate than the last dollar. So on this income that comes from this company, there's effectively 2 layers of tax. There's one that's flat, and there's one that's graduated. So if you are the sole shareholder of a C corporation, all that falls on you one way or the other. So that's why it's really important to understand if you choose a C corp, you're going to be paying these taxes at different rates at different times. So I'll come back to this in a second, but I want you to understand something here. It's very important. You do not have, in most cases, in some cases you do, but in most cases you do not have to pay dividends. So if you don't pay a dividend, what tax do you avoid for that year? Exactly.
So that money would just go back into the business.
Yes. So you see, if you think of a few ways where that could be useful? Mm-hmm. Yeah. Okay. Anybody have any questions on this right now for C Corps? So in the business world, everything else is a pass-through. We'll go over down here. So I'm going to jump a little bit around this slide. So pass-through entities include sole proprietorships. On a personal income tax at 1040, you might have heard of Schedule C. That's where it goes. Partnerships and S corporations. Those are the 3 primary pass-through entities. There's also trusts, but that is really complicated. We're not going to get into that. So these 3. So what does that mean? Pass-through entities incur one level of taxation. So a couple minutes ago, we talked about a C Corp where the corporation pays the tax, and then when it gets dividend, the person who gets the dividend pays the tax. In a pass-through, there's only one level, and that's the individual income tax rate. However, remember, personal income tax rate is graduated. The highest rate is 37%. What did we say the C Corp rate was? 21. Do you see where that could be significant? So it's one hand it gives, the other hand it takes away, right? You have one level.
People hate the IRS.
That's why people hate the IRS. There's one level, but depending on how much money you make, it could be higher or lower. Okay. That's where tax planning comes in. Here's the other thing about pass-throughs, and we'll go through this in a couple other slides, but I want to reiterate it. In a pass-through, whatever your taxable income is. Your taxable income is the revenue that comes in, that's taxable, minus your deductible expenses. Whatever that is gets put on your personal tax return, and you have to pay personal income tax on it. So this is really important what I'm about to say. It does not matter if you have the cash or not. You owe the tax. Okay? Doesn't matter whether you have the tax. You owe the cash. You owe the tax. This is another drawback of pass-throughs. They say, hey, it's great. It's one level. But it's higher in the SCorp, and you got to pay the tax immediately. At the end of the year, and actually through estimated payments throughout the year, there's no ability to manipulate. Remember a few minutes ago we said in a SCorp, if you don't pay the dividend, you don't pay the tax? That's not the case with a pass-through. You earn it, you pay it. There's no ability, unless you use the timing mechanisms within a pass-through entity, there's no ability on a personal level to shift that income. It doesn't exist. So, what most people do in pass-throughs is they take a distribution to pay the tax. But what happens if you are growing a business? What happens if you're a growing business? How do you think your cash flow is?
Very good.
Right? Because what are you doing when you're growing? What do you take? You earn some profit. What do you do? Turn around and what?
Spend it.
Spend it on what?
Whatever you need to run the business.
Right. Machinery, equipment, employees, right? It's very common to be growing and have absolutely no cash whatsoever. But you owe that tax. This is why you have to be careful with pass-throughs. There are some clients I have where they have multiple investors. And I said, are they aware that they're going to get this piece of paper called a K-1 at about the middle of March, and if there's income on there, they're going to have to pay tax on it when they haven't seen a dime from you? Do they understand that? In most cases, no. I go, well, you better tell them. Because if they have to pay tax and they don't have the money, guess who they're going to be mad at? You. Right? So, pass-throughs are great, but you got to understand what you're getting into. It's like jumping in a pool. You got to know how deep it is. Because if you can't swim, don't jump in the deep end. Right? So, you give up 2 layers of tax, but what you have to deal with are sometimes higher rates and the inability to control when you have to pay that tax. So that's sort of the cosmic trade-off between a SCorp and a pass-through. Note on LLCs. So whenever I get a new client referral, I go, what tax entity, what entity do you have? Well, I have an LLC. I go, okay, what tax entity do you have? And I'm not stuttering. It's not that I didn't hear them. It's that they have no tax identity. There is no LLC tax return. I challenge you right now to Google it. Look for the LLC tax return. If you find one, it's a fraud and it's a scam. There is no LLC tax return anywhere. Never has been, never will be. Okay, so what does that mean? What it means is LLCs are assigned. If you don't take any action, the IRS decides for you. It's called a default classification. If it's a one-member LLC, unless you elect otherwise, it's an individual income. It goes on at your individual income tax return as a Schedule C. And if you don't, the IRS will contact you. If there's more than one member, and this is the worst one, then the IRS is going to classify you as a partnership. Partnership tax law must have been written by the devil. Okay? It is sometimes punitive, it's complicated, it's inexplicable in certain portions. And the reason being is, the thing about a partnership is, in most cases, you can take property in and put property into a partnership, take property out, and there's no tax effect at that time. But if you sell it later on, you've got to figure out what the tax is. And if you haven't kept good records and the partnership hasn't kept good records, you won't know how much tax you owe. So what happens is it's almost like the assets you put in, it's like you put them in a little suitcase and you put them in the partnership for a while and you're like, okay, I'm done. And you pick up your suitcase and you walk away, but all those tax issues come with it. And you have to track every single one of them. And if you don't, you're going to be in a lot of trouble. So let me give, if you take anything away from this seminar, one thing. If someone says, I have an LLC, ask them how many members are in it. And if it's not their spouse and it's more than one, say, oh, then you're a partnership. And if they say, what? Do not invest with them. Because you will have trouble. Partnerships are extremely complicated. Even the simplest ones can have these issues that are just very hard to untangle. So unless you know exactly what you're doing, do not get involved in a partnership. Very complicated. An LLC can elect, however, to be...
Question for you, Steve.
Yeah.
You mentioned spouse, so the spouse is treated differently?
If you've... Yes. So on a joint return, a husband and wife are considered a joint taxable unit. So in most states, if a husband and wife are the only unit holders in LLC, it'll be treated as a single owner, which means it goes as a Schedule C on your personal tax return. Yeah. But it depends on the state. But yeah, so I'm not saying partnerships aren't good. There's a lot of them that are very good. There's very good business applications for them. But you really need to know what you're doing. I have a client. I was talking to Don about this. I have a client. I looked at the tax return, and he had a 1099. Does everyone know what a 1099 is? Like if you're an independent contractor and you don't get payroll taxes paid out, someone sends you income, and you have to declare it in your tax return. So he sends me his 1099. I go, who owns the company that paid you? He goes, I do. I go, okay. Who owns the company that did the work? He goes, I do. Okay. Does someone else own it? Yeah, my friend. Okay. So let me get this straight. A company you partially owned paid another company you partially owned money. Does that make anyone nervous? It should. So as it turned out, he actually filed the wrong tax form. He didn't ask me. He didn't ask any tax advisor. It's impossible for a partner to get a 1099 from its own partnership. The IRS basically disregards it. It pretends you didn't send it. And if it finds out you didn't send it, it will levy penalties on you to say you didn't file the proper tax form. So that's just one of the very, very small way that partnerships are very complicated. So and again, maybe this is a plug for my own profession, do not ever try to do a partnership tax return yourself. You will get it wrong because even the pros sometimes get it wrong. So do yourself a favor and hire someone. An LLC can elect also to be an S corporation and a C corporation. So it doesn't matter how many you have, right? So if you have one member, if it's just your spouse, if it's 100, you can elect. You can fill out a special form in the IRS, and there's timing is important. It has to be a certain time before a certain date of the year, or else you got to wait till the next year. You can elect to be it, and then you have to file the proper tax return. So, again, LLCs have no tax identity. If you don't decide, the IRS decides for you, and if you do decide, you have to file that tax return. Does anybody have any questions on that?
Can we change S to C, C to S regularly, like year on year?
No. If you change from to an SCorp, and you have to wait 5 years to change back. Because exactly what you said, if you do that the right way, you can save yourself a lot of tax. The IRS knows that. So they have rules in place that say, yeah, you can walk through the door, but you got to wait 5 years to walk back through. Because there are certain tax attributes that have a limited lifespan. Some are around 5 years, which is meant to defeat this sort of tax engineering, they call it.
declare through additional paperwork to be an SCorp or SCorp?
If you are the only owner, you don't have to do anything. And you will be taxed as a sole proprietorship. If you want to be an SCorp or SCorp, you have to file an election form with the IRS. Yeah. Generally, it's got to be 75 days after the first of the year. In most years, it ends up being March 15th. Might be March 14th. The IRS sometimes counts days a little bit differently than we do. But if you don't file it by then, you have to. You can file it. They'll say, fine, next year, January 1st, you're good to go. They won't backdate it. You can backdate the forms. So let's say it's March 1st, 2019. I could file a form today for a brand new LLC saying I want to be treated as an S corporation from January 1st, 2019. They'll go, no problem. If I wait till March 16th, they'll go, sorry, got to wait till January 1st, 2020. So there's a cutoff, there's a deadline, and if you miss it, you're done. You got to wait. Does that make sense?
So any business that as a freelancer could transact if you're not, well, for me, I'm not earning anything currently, but I'm interested in doing the LLC for the reasons I stated, but as a sole proprietorship, that's basically, would that be the 1099 that you're referring to?
So if other people pay you, right, then, and you're not an employee, they would file a 1099.
Okay.
So a partnership can receive a 1099 from another entity or person, but it can't send a 1099 to its own partner because it's expecting what's called a Form K-1, which is a lot more complicated.
The investor scenario that you share with us, if someone invested in your company and there's no return, you're saying that the investor is looking for the money to return, that they're expected by the IRS to pay a tax.
Yes.
Right. Got it.
Yeah.
Okay.
Now, if you have a loss, you can fold that into your income, and and actually deducts the amount of income subject to tax. So there are financial advisors out there that specialize. Usually, it's high net worth people with a lot of money. They'll say, "Well, I don't want to pay any more taxes." Well, who does, right? But when you're wealthy, you can pay people to help you pay less tax. And so what happens is they have these very elaborate investment companies where they generate losses with debt, where you can deduct money today, and then hopefully later on, when your income is lower, you shift income to later on, your later years when it's lower. Or if you're really wealthy, you wait till you die and you bequeath it to your kids, and then you don't pay tax on it. So
you have the taxes to pay on bequeathment, right?
What's that?
When you bequeath or the taxes to anybody in the son, you don't pay the estate tax.
Estate tax, if it's above $10 million.
Oh.
If it's below $10 million, you don't owe a dime. So if you're really savvy, you can, in fact, if you really engineer this and you owned a bunch of real estate, you incurred a lot of debt, and you continually took the money from one company to fund another, it is possible to thread the needle. And if you kept that going until the day you died, you could literally avoid paying any income tax.
That goes back to the planning.
Yes. And you're going to pay someone a lot of money to engineer that, because that's going to take hundreds of thousands of dollars of tax research and papers, and there's something called private letter rulings with the IRS. The base private letter ruling costs $100,000.
What is it, private?
Private letter ruling. So if you a private letter ruling, so what it is you have a tax attorney or a tax practitioner write a very technical memo. And you say, hey, we're going to do this transaction. We're pretty sure it's not taxable. Can you give us a ruling? And they say, sure, give us $100,000. And for $100,000, someone in the IRS will write a memo and tell you whether you're right or wrong. And if you're right, it's a get-out-of-jail-free card. Now, that's provided you do exactly what you said in the memo. If you stray at all, they're going to yank it, and they'll say it doesn't apply. But what I'm saying is that kind of gain, pay no income tax, that is for the very, very wealthy. It would probably cost you, what I just said, would probably cost you a few $1 million in tax advice. So unless you stand to pay $2 million less in tax, don't even bother. So,
not really a question, but I think it's kind of interesting. I used to to work at a Disney resort in Florida, and that paying each other. I could imagine the tax help or whatever they do, because we were always paying each other at Disney, right?
Mhm.
We were at sports doing things, paying Epcot, and Epcot was paying us, paying merchandising, and I can only imagine how their business structure is.
That's interesting. So those would be intercompany transactions, probably.
And that's why I don't know if we were like operating our own sort of economy.
Yes.
We really just build within Disney World our own economy. We're invoicing each other, and then
That's a very good way to put it. Within a consolidated tax return, transactions between companies within a country,
right.
like within the United States, essentially one negates the other. Right? You don't pay any less tax, you just don't pay any more tax. So now, if you're cross-border, I don't want to go there, because then you're into international taxation, and that is just a whole other level of ugly.
We were always told that don't pay anything.
Yeah,
Or other
yeah.
entities.
It's stopped at the border, right?
Yeah.
Yeah,
Don't
yeah.
talk to California unless you
Yeah.
go through certain channels.
Yeah, that can get very. And the European bloc just changed all their tax rules in terms of international tax. So now everything that people used to do, it's gone. And now they got to start over. So very complicated. So that's another thing, another takeaway. So number one is don't get into a partnership unless you really know what you're doing. Number two is if you are contemplating doing business in another country, stop and talk to a tax advisor. Because I guarantee you, death and taxes are certain. Another thing that's certain is if you do business across borders and you don't know what you're doing, you will pay for it. And usually what will happen is something like years later, they'll say, hey, this person should have paid withholding tax. And they'll contact you and you say, here's a bill, and here's a penalty for 100%. And by the way, you're going to get a visit from our customs agency, and they're going to talk to you why you illegally traded across borders. So it is not to be entered into lightly. I was the controller for a biotech startup that was backed by, have you ever heard of Sun Microsystems? Vinod Khosla was one of the prime founders. He backed the company I was in. It was venture capital backed. They had an office in New Zealand. They had a lab in New Zealand, an office in Chicago. They had a plant in China, and they had a plant that was starting up in India. They did some consulting for a company in Germany, and when we got the bill, they billed them $100,000. We only got 80. I go, why did you take withholding tax? 20%, because you're a foreigner. We don't know if we're ever going to get the money back. How do I get the money back? Easy. File tax return in Germany. But I don't have any tax in Germany. Then you can't file a tax return. These are the traps that are set with international tax.
But if paid, so I have a business in India,
Mm-hmm.
only subsidiary of US-based company. I pay taxes there, zero taxes because I don't make money there, it's all employed.
Mm-hmm.
And show as a tax here, you are saying there's no money here. Form 8841 something.
It depends if there's a tax treaty, and it depends on the type of income. There are at least 5 types of income that tax code recognizes. So in your example, it depends, number one, if there's a treaty. If there's not a treaty, then there's a bunch of other rules. Depends on the kind of income. If it's capital income, there might be one rate. If it's ordinary income, it might be another rate. But you're actually proving my point. If you plan it carefully, you'll be just fine. It's when you just kind of sell it and hope and pray is when you get in trouble.
Right, agree.
Yeah, yeah,
Lot of
yeah. Now, is there a chance you get away with it? Sure, there's a good chance. There's also a chance you won't. Some of my clients are gamblers, so to speak. I'm like, if you want to try it, go ahead. And if it crosses the line, I said, well, then you need to find someone else to prepare your tax return. If it's gray area, I say, these are the risks you take. I have to inform you. I do it in writing. I go, you're rolling the dice. Once 7 years go by, you're home free. Is it possible you're going to make it through? Yeah, it is. It's also possible you won't. So a lot of it depends on your personality type. Are you a risk taker? And if you're a risk taker and you want to push the boundaries, you can. but one day you may end up with a big tax bill, so, and a legal bill. So again, you can elect to be, an LLC can elect to be an S corporation, a C corporation, or you can just stay. You can actually elect to be a partnership too, but that would sort of be double work, because if you have more than one member who aren't spouses, you're going to be classified as a partnership anyway. Okay, so let's kind of review sort of the trade-offs here, right? Everything in life has a trade-off, right? Same thing with pass-throughs and C corps. Tax liability advantages that we went over. One level of taxation, okay? Taxable losses in some cases. There's something called passive income, which is a whole other issue we won't get into. Sometimes it can reduce your individual tax liability, okay? Tax liability only disadvantages. Tax is owed when earned, not whether owners or company have the cash. That's what we went over earlier. C corporations. Flat 21%. Great. Corporation pays the tax, not the shareholders. Okay. Tax liability disadvantages. Income is taxed at the corporate level and again to shareholders when dividends are distributed, if they're distributed. In a closely held corporation with 5 or fewer people, if it's a certain type of corporation, they do services. If you accumulate more than $250,000 without paying a dividend, the IRS will pretend you paid a dividend, and they will tax you on the dividend. So if there are few enough shareholders, it's a certain type of business, and you have a lot of money that you haven't dividended out, eventually you're going to have to do it, or else they're going to charge you. They're going to pretend you did. The IRS does this a lot, by the way. They create fictions, and those fictions are legal, right? It's like a bad story that you can't change, and they go, yeah, we know it doesn't happen, but we're pretending it did, so get out your checkbook.
And when you say 250, is that sales or income?
Accumulated earnings. Yeah. That's sort of a magic line. And again, it has to be a certain number of shareholders in a certain type of business. And that 250 number could go up or down depending upon whether you're planning to pay dividends or whether you paid them last year. There's sort of this 3-year averaging rule. It's never simple, right? But that's just a rough guideline. So, you notice I say tax liability only because these don't encompass legal or business or other issues, right? So this slide is only for the advantages or disadvantages on tax liability purposes. So, S-corps. So S-corps are sort of a hybrid between partnership tax law and C corporation tax law. So this is where a lot of people and a lot of my clients actually save quite a bit of money. It's sort of, remember, so I just said a couple minutes ago, the IRS kind of creates these fictions. And it's not nefarious, it's to make sure the tax system is equitable. Okay? But they create these fictions. One of these fictions is called a reasonable salary. So here's why this is important. If I make $100,000 in my business and I am a sole proprietorship and I have a Schedule C, I'm going to pay $15,300, 15.3% of my net income and self-employment tax. If I have an S corporation and I pay myself a reasonable salary, quote unquote, at $50,000, I'm going to pay half as much self-employment tax. So just by being an S corp, I've saved myself $7,500 year after year after year. So you see why this is valuable? Right? But the IRS knows this. And they kind of play what I'll call it sort of a hide-and-seek game, right? And what they say is, we know you're playing with this. That's all right. But don't get greedy. So that's kind of what they say. And they say, well, how do you know I'm not getting greedy? Well, pay yourself a reasonable salary. What's a reasonable salary? Not going to tell you that. That's essentially what the tax code says. It's just silent. Pay yourself a reasonable salary. What is that? Not going to tell you. Not going to tell you. Right? So if you read what they call Editorial Tax Material, so in the tax world there's regulations, there's tax code, there's procedures, which come directly from the Department of the Treasury. Then there's court cases, which is called case law, And there's tax court cases, which is called tax court case law. But then there's something else called editorial material. So what is editorial material? Editorial material are theories, essentially, or mini case studies written by tax practitioners that are published. The most formidable being, in the accounting world, the AICPA, the Institute of Certified Public Accountants, publishes a magazine called The Tax Advisor. And these are very, very well written, very well edited. It's the most sound, comprehensive, and with the highest amount of integrity tax opinions you're going to find outside of a textbook. If you read it in there, you can be 100% sure it is dead on. That said, the reason they write these articles is because the tax law isn't clear. And the tax law is well over 100,000 pages long when you consider court cases and regulations. Once in a while, there's bound to be a conflict, right? There's going to be contradictory material. And there's going to be things the IRS says, and there's going to be things more important that they don't say. So what these tax articles try to do is they say, well, I'm going to kind of fill in the blanks here. And here's how I'm going to fill in the blanks. Well, if I look at this case and I look at this regulation, the IRS must think this is true. So if this is true and I plug it into this tax law, this must be the answer. So it's sort of like this giant algebra equation where you're not sure what all the variables are, but you can sort of, kind of, take a guess, an educated guess, right? So that's what these articles are about. This is called editorial material.
Do you suggest as a layman, as a non-accountant people, read those articles?
Good luck.
Possibly, right?
I've been a CPA for 30 years. I have a master's in taxation from the University of Cincinnati, and I still don't understand them all. So good luck.
This is not possible.
Yeah, it's very, and there are tax attorneys that don't understand it.
Right.
Go ahead.
Isn't an SCorp a little more liable than a C? More liability to it?
That's a question for a lawyer. I don't know. So in any case, what I was saying about editorial material, there's lots of editorial material on what a reasonable salary is. So when someone says, pay yourself a reasonable salary, if they're a competent tax advisor, they will be basing this on editorial material that they've written.
Right. But there's also, like, in your industry, you can see how much a market can bear on what expertise is bringing. That also can be used, right?
The editorial material that I've seen says you should pay a market rate.
So what is the advantage or disadvantage of going very high or very low?
If you go too high, the IRS will be very happy, but you'll pay a lot more tax than you have to.
Right.
If you pay too low, if you're a gambling person, you have a gambling mentality, you can hope that they're not going to call you on it.
Can I increase or decrease salary over a same year? Like,
I wouldn't recommend it. So let's go with the fiction that they create. If you work for somebody, do they raise and lower your salary every year?
Well,
No,
hopefully they raise
yeah.
it.
Unless you're on commission, right? Unless you're paid on commission,
Bonuses, bonus structures.
right. But does it ever go down? Usually. Sometimes. But most of the time, it stays the same. You don't get a raise, right? Once in a while, you might get a pay cut, right, if you're in a bad company. But I worked in corporate America for 25 years. I never once had my salary cut. I got a bonus about half the years. So, to your question, if you pay yourself 50 one year and 20 the next year, what's the IRS going to think you're doing?
Hiding money.
the gaming system.
It's not a reasonable salary. So, that said, let's talk about a reasonable salary. It's a market rate, right? It's a market rate. What would you pay someone to do the job you're doing? And most business owners go, oh, there's not enough money in the world to pay me what I do. I'm saying, I know, I understand that. I understand it's your baby, but pretend you're somebody else and it's not your business. What would you pay someone to do it? And so there's three things that bear on it. One is, if I was making a lot of money, what would I pay this person, right? So if you're very, very profitable and you're making lots of money, the IRS is pretty much going to expect to pay yourself what you would pay someone else, which is probably like midpoint, right? So if you can go to salary surveys, like Robert Half has salary surveys, you can go to the Department of, forget what it is, Bureau of Economic Statistics. They have this called occupational outlooks, and it's good for college students. They want to see what they want to do with their life, or people who are just coming out of their teenage years. They have salary midpoints, so you can look to that. The other thing is to think about is, are you a small, medium, or large company? In my career in the corporate world was split between almost evenly, not by design, but evenly between smaller companies and larger companies. The smallest company I worked in, besides my own, was a $3 million manufacturer back in 1991 of cast nylon stocks and shapes, and they replaced metal. The largest company I worked for was BP, which at one point was the second largest company on the planet. So I worked in really big and really small. And what I can tell you is larger companies, if you, at a certain level, pay you more. Right? And why do they pay you more? Because they have more money. Right? And if economics are any clue and you believe in it, the reason they pay more is because you're better at what you do than someone else. So that said, you can take into account the size of your company. So let's just say you're paying someone, a general manager. So I have a couple dog walking clients, right? And they have general managers because it's a complicated business. It doesn't pay much and it's complicated. A general manager in a large company that handles a lot of logistics of people and things, you pay them $150,000 a year, maybe $200,000. If you're a small company, you might pay them $50,000, right? It depends on the complexity of the job. Right? The other thing is, it comes down to economics. Can you afford it, right? So let's go back to what I said at the beginning of the presentation. Employment taxes are a separate bucket from SCorp, from income taxes. So if you have an SCorp and your salary puts you at a loss, you're going to have an ordinary income loss, but you're going to be paying self-employment taxes. Does that sound reasonable to you? Well, if you paid someone else, in most cases, you're going to pay them a salary, right? You owe it to them. It's a contract, right? And if you don't pay it to them, you're going to run afoul of labor laws. So all other things being equal, the IRS would expect, if it was a reasonable salary, that it wouldn't go up and down every year. You can do a bonus program. I think it's risky, but that's my opinion. Now, if you're paying regular employees a bonus, that's a different story. But if you're paying yourself this tiny little salary and then you bonus yourself out at the end of the year, you're going to get a knock at the door. Right? It's pretty obvious what you're trying to do. So that said, how do you pick a reasonable salary? One thing that I do, and this is just what I do, it isn't written anywhere. Some editorial material has alluded to it. It hasn't said it's rock solid. I'm trying to put every disclaimer in the world on this in case you haven't figured it out. This does not mean if you do it, it's going to work out. Okay? But one of the things I have recommended to my clients is the IRS publishes a compendium. It's a summary of every single tax return that was filed every year for every type of entity. I forget what it's called right now. So let's say for 1040s in the United States in 2017, this was the average income, this was the high, this was the low, these are the average deductions. For S corporations, this was it. And you even subdivide it by, on your tax return, you put a code, an industry code. You can even drill down by industry code to a certain level, not to every code, but to like the higher level groupings. So what I tell people is, go to that website, and I send it to them. Look, get as close to your industry as possible. Pick S corps, and they'll actually have owner salaries separate because officer, not owners necessarily, but officer salaries are broken out from everyone else's salaries. As you can imagine why, right? Because they want to keep an eye on this thing. Look at that line. Assume that those people are also owners. What's the percentage of income on average that salary is? And that's about what most people would probably consider a reasonable salary.
So, quick question. This is very good, first of all, what you told a couple of last half an hour, 1 hour. When you start a business, right, most of the times you bring your own money, savings, or then hopefully the business grows. How to take out the money which I invested earlier over a year, because the year has passed already, like financial year is over. Can I take it back in my own name?
As long
Pass through, so I can
Yes, as long as your equity account doesn't go negative. Does everyone appreciate the difference between equity and debt? So in a business, you have your assets, right? And then you have debt, money you owe to other people, not to yourself, but to other people. Shareholders sometimes give loans to themselves, but basically, money you borrow, credit card companies, banks, other people, Aunt Joe, Uncle Ida, whatever, right? Your assets minus your equity, minus your debt, is your equity for all intents and purposes in a SCorp. At the end of the tax year, if your equity goes negative, you will owe tax on that amount over your equity. Because what you've done is you've effectively turned debt into income. Because you've borrowed from someone else and you've paid yourself. And you've taken it out of the company. So therefore, you made money. If the distribution at the end of the year, if your equity account is not negative, you will not owe any tax on the money that you took out. Those are called distributions. So I forgot his name, but what he was saying is one level of taxation, right? So remember saying that in C Corps, dividends get taxed. In S Corps, they don't. So if you don't deplete your equity, you don't pay tax on it. It's a single level of taxation. You pay it once. That's when you earn it. When you take it out again, when you take out the actual cash, you don't pay tax again unless you overdraw your equity account. Does that make sense? So it helps to know this, that in the tax code, if you have a debt and it's forgiven, you have income. So if you borrow on a house, there are some exceptions. One of them is houses, but let's just say you have a rental house and it's a business. If you borrow $100,000 and it's $50,000, you say, "Sorry, I can't pay the money back," and the bank goes, "No problem." They write off the 50. You have to put $50,000 of income on your tax return.
So vice versa, if my client owes money and he doesn't pay, it's still a loss because of cash basis, right?
No, I'm talking if you have debt that you owe someone else and someone else writes it off,
Right.
then that's income to you.
But in other case, there's nothing can do.
No.
Just loss is loss.
Just loss, right. You mean the person lending the money?
No, the person owing me money for services.
They would have income.
Yeah.
So if they owe you money and you forgive the debt, they have to put income on their tax return.
Oh, that's
Yeah, because you're the one forgiving the debt.
interesting.
Yeah, it's money that was owed to you, and now you're saying, "Sorry, you don't have to pay it." If you owe money to someone else and they say you don't owe it, then you have income. Because if you think about it, it makes sense. Because if they didn't do that, right, then what would everybody do? "Well, I'll loan you money. I'll loan you money." "Oh, don't worry, don't pay it back." Well, all of a sudden now you got a bunch of untaxed income.
Even though it's
So-
cash basis or accrual basis?
Yes. Yes. There are very few exceptions. It's tax code section 108. There's about 8 subsections, and there's 5 exceptions. And those exceptions are very, very narrow. So what I tell people when they first call me, they go, "I was forgiven debt. Do I have income?" I go, "Yes." "Is there any way out of it?" "Well, let's talk." And usually that's a phone call, and usually it's a couple meetings. I have a client where they wanted to do it, and I said, "Let's talk." And I go, "Is it?" They go, "Is it taxable?" I go, "No, let's talk." I had to bill her $800 to tell her whether it's taxable or not, because it takes that long to figure out. So if your debt forgiveness is going to cost you less than $800, just put it on your tax return. Because it's going to be a lot easier than talking to me, because I'm going to talk to you like this all day, and then you're going to get tired and you're going to fall asleep because you know what the hell I'm talking about and you just want it to stop, right? So do yourself a favor. All right, so we beat reasonable salary to death. So the takeaway is there's no definition. Use common sense. No. Your paycheck, so when you're an S-Corp, shareholder and employee, you're going to give yourself a paycheck. You're literally going to have a W-2, and you're going to put it on your tax return just like you work for somebody else. This is part of the fiction that the IRS creates. And you have to do this, or else you're not going to be in compliance. There's a lot of, we'll go on to the small business tax software in a second, but, well, I'm a little down on Square. I canceled my subscription and they keep charging me. But Square does have it for $35 a month. You can pay, I think, up to 10 employees, something like that. And it's really good. They file all the tax forms for you, you direct deposit. It's pretty good. So I would recommend, if you don't want to deal with this, what I tell people is go to an outsourced tax agency, because what I charge you would be 3 times as much, because payroll taxes are high risk, low reward. They're very easy to get wrong. And if you get them wrong, the penalty is literally, I'm not making this up, because it's trust fund, it's 100%. So if you underpay $500 in payroll taxes, you will get a $500 penalty. If you underpay $10,000, you will get a $10,000 penalty. And that is immediate. There's no reprieve, there's no time, it's 100%. So do yourself a favor, hire an online tax service, and let them do the work.
For the payroll.
Yes, for the payroll.
So whoever does the CPA, does the work for payroll, they might also make some mistake, right?
I mean, yeah, you can always make a mistake, yeah.
Anybody, whether QuickBooks or ADP, or
Yeah.
hopefully they don't make a mistake.
Right.
So the liability goes to whom? The business owner or to the CPA? Or
Technically, it's on the, so if ADP were to fold up, which maybe it will, but you would still be liable for the tax. But,
penalty, I mean.
what?
Penalty.
I'm sorry, what?
The penalty, right? Like if
Penalty. Yeah, you'd be liable for that. Just because you outsource it doesn't mean you outsource the penalty. Now, if you're ADP, it's a giant company. It's been around for at least 50 years. There's a pretty good chance they're going to make you whole, right? If they make a mistake, they're going to pay it. And that's one of the benefits of going with a larger provider for payroll taxes. Because again, it's high risk, low reward. They are insanely complex forms to fill out. They're excruciatingly detailed, and they're no fun. So if you're going to pay $35 a month, just trust me, pay the $35 a month to pay yourself a paycheck, because it's going to end up being a lot less expensive, because I guarantee you, you will make a mistake. And it's going to be at least as much as if you just paid these people to begin with. So I would go to Square Payroll or something else, or there's lots of startups online. Let them handle it. So.
what is a Square payroll?
Square.
Do you have a referral code from you? I can use it.
Sorry, what? No.
Do you
No.
have a link or something?
No.
So
It's
I'm looking myself to change a CPA to either a self-help or QuickBooks or.
yeah. So Square is like the same people. You know, like at small restaurants, or if you go to yeah. You go to a flea market, they swipe it. They also have payroll. Like I said, though, I canceled it. They're still charging me. I'm in this continuous loop. I actually had to call my bank and tell them to stop, to give me back the money. So I'm a little sour on them right now. It doesn't mean they're not a good company, but
And QuickBooks has 2 levels, so there's the full service one, which will handle all the tax returns, the other one won't, so you have to do that yourself.
yeah, exactly. QuickBooks has it too.
How much do you charge?
I don't do them because I would charge way too much. Estimated payments, which we won't even get into, that's really complicated. So for like a simple SCorp tax return, I'll charge like around $600. So this is if there's no inventory, if it's service-based business.
A year or month?
A year for an SCorp tax return.
A year.
A year. It's only one time. You do it one time a year. SCorp tax return. Someone asked me, yeah. So someone asked me, well, what will you charge me to do your estimated payments? I go, $200 a quarter. Like what? It's complicated. It's really complicated. Same thing with payroll taxes. It's really complicated. When you get in a rhythm, that might work, but it's very easy to make a mistake.
So on a yearly, it's $2,400 or something?
I'm sorry, what?
So yearly, how much it costs to, like a single person?
To do estimated tax payments?
Everything.
Oh, I don't know. It depends. a lot. It depends on the business, it depends on complexity, it depends if they have other income streams. So if I have a person who's got a closely held business and has no investments, and one person that has a bunch of investments and a closely held business, it's going to be way different, because dividends are those, who knows how much they're going to be, right? And you start getting into estimating, and then you say, well, do you want to avoid penalties? Do you want to avoid paying tax? I want to avoid paying tax. And so, well, then we got to estimate. It's going to get very, very complicated. So.
I just want to do a time check and let you know there's like 20-ish minutes left.
Yep. Okay. All right. So I kind of went over this, but when you pay tax, a lot of times you pay a tax when you're exiting a business. That's why tax planning is important. Putting property into or taking out of entity in a corporation, when you put property in or take it out, you can get taxed on both ways. So you got to be careful. It can have very different effects. So there's something called capital gains tax rates, and there's also ordinary tax rates, and there's passive tax rates, and there's several flavors of capital gains tax rates. So there's at least 5 different types of tax rates that can apply. And we talked about earlier, in a pass-through, if you distribute money and you don't deplete your equity, there's no additional tax. If you deplete your equity, there is tax. And usually the die is set, right? So it's very hard to change. I'm going to jump out into an Excel workbook. So this side is a pass-through. This side is a C corporation. Here's the individual tax rates for 2018, the graduated rates. Income $100,000, you distribute all the cash. So let's take a look at the tax effects. Pass-through, you end up paying almost on $100,000 in income, you end up paying self-employment and income tax of over $27,000. Again, you're distributing all the money. In a C corp, you're paying $30,000. Okay. However, look down here. Where is it? This is the dividend. 22%. This person's in the 22% tax bracket. That's $8,000 of tax and dividends. But what if you're planning on keeping the cash in the business? All of a sudden, this year you only pay 22 as opposed to 27 with the pass-through. So you see how this can flip? And you see why planning is important? So I won't go through all these because we don't have time and it would really be quite boring. So generally speaking,
Hit the left.
left, this one? Yeah. At modest levels of income, a pass-through structure usually results in less current tax. That's not to say later on you won't pay more when you exit the business. If cash is retained in a business, a C corporation may be more advantageous. Depends on the type of business, whether you're going to plow money back into, what you're buying, and why you're buying it. Upon a sale or exit, pass-throughs and C corporations can have really different tax effects. And you also want to consider, let's say you're going into business with people who are all risk takers. And there's a good chance that they're not going to have the cash to pay the tax. You might want to do a C corp anyway. So there's non-tax considerations. It depends on the nature and character of the people you're going into business with. If you're pretty sure they're not going to have the money to pay the tax, make it a C corp. Because the corporation is going to pay the tax. Kind of closing comments on this. Intangible assets. So I have a lot of clients who develop software. Intangible assets throw it's a whole different ballgame. Depending upon how it's created, how you acquire it, and how you monetize it, at least 3 different tax rates can apply. So it changes the tax picture. As corporations, these are really important. Only natural persons. So with some very few exceptions, another company cannot own an S-corp. It has to be a person. That person cannot be foreign. they have to be a citizen, a U.S. citizen. They can only have up to 100 shareholders. If you go over that, you lose your SCorp status, become a C-Corp, and you usually don't know till 3 years later, and the IRS sends you a big bill. Right? There's a 5-year waiting period to reapply to be an S-Corp, so you better be sure. And profit must be split. This is really, really, really important. So I said a partnership is complicated. One of the reasons it's complicated is you can split your income pretty much any way you want within certain boundaries. S-Corp can't do it. It's a very simple tax structure. It's very simple to administer, comparatively speaking. But if you have 15% of the stock, you are allocated 15% of the losses and gains and 15% of the distributions. If you do otherwise, you will revoke your S-Corp status, you revert to C-Corp, and then you're going to be paying yourself dividends, and you're going to have all this tax that you're not paying until years later when you realize it, and then you're going to owe penalties on it. So S-Corps are really good if for small businesses, steady businesses where you think you're only going to have 2 or 3 shareholders, you're not really going to change the business, you're not going to do international. You know, if you just want to set up a little shop and do that for the next 40 years, S-Corps are the way to go. If you think you're going to change and set the world on fire, forget S-Corps. Partnerships, again, you can split income virtually any way as long as tax isn't evaded. C corporations, you can have multiple classes of stock, and anyone can be a shareholder. So for the price you pay of the higher income tax, you get infinite flexibility. Right? Literally anyone or anything can be a shareholder in a C corp.
Even the foreign persons.
Yes, foreign company, for any trusts, anything. So that's it on taxes. There is another part to this. There's only a couple of slides. I just do want to do this, and we'll stop for questions. Small business accounting software. So if you go over some of the basic functions, what is small business accounting software? You invoice clients, right? Record and pay bills, basic financial information, right? Some add-on features. The next slide has some common popular ones. Payroll, W-2 processing. Don was mentioning QuickBooks has a payroll service of 2 or 3 different levels. Tracking of time, so if you have a project-based business or like repair shop or you do service calls, there are add-ons for that. Multi-currency, let's say you have Canadian customers and Mexican customers, or you sell internationally. Some have multi-currency. You take credit cards, make electronic payments, track inventory. As soon as you start tracking inventory, everything gets more complicated. Both tax, book, accounting, everything. It's just a different world. It has a whole layer of complexity. And then purchase orders. So I did a survey. So this was supposed to be a couple months ago, so this is current as of a couple months ago, but it doesn't change too much. QuickBooks is about 85% of the market. It's pretty stable. A lot of things that are really annoying about it, but it is stable. But it is a little bit buggy sometimes, but it's a giant, giant company that backs it. And one way or another, they may not get you the software, they may not get it to work like you want it, but they will get it to work as it's designed. So, it's a giant company, which is good backing, but also you're one voice in a chorus of millions. So, there's 3 different flavors for online. There's $10 a month, $17 a month, and $30 a month. Now, this is based on having a QuickBooks accountant. I'm a QuickBooks accountant. Don's a QuickBooks accountant. You double those if you don't have a QuickBooks accountant, if you pay retail. You can also buy the desktop version, which is $300 a year. You can usually use it for 2 to 3 years before they make you upgrade. The desktop version of QuickBooks has, what do you say, maybe 10 to 20 times the features of the online?
Yeah, and that's better for inventory.
Yeah, so don't try inventory on online. You'll drive yourself crazy. Xero, they're out in New Zealand, and they're $9.30 and $60 a month. It's a lot like QuickBooks, but a little more basic. In some cases, it's easier to use. In other cases, it isn't. I would recommend doing the trial versions of both before you decide. For Xero, some businesses, it could be very good, and for QuickBooks, some can be very good. Wave. There's a free online version, but it's very limited functionality. But if all you have is just you and you're doing services, might be the good way to go. You don't have a lot of bills. FreshBooks, $15 a month. There's no payment of expenses, but $25 to $50 per month, depending upon the number of clients and transactions. So in FreshBooks, if you have under a certain number of transactions, and it's pretty limited, it's 15. If you go over that number of transactions, then the price goes up. Cashew, online only. There is no free version. It's $30 a month, unlimited transactions. So 1, 2, 3, 4. So 5 that are the most popular. I'm sure there's a few more, but those are definitely the ones that are, I would say, the most heavily publicized. Yeah. And they all pretty much.
Zoho Books is very good.
I'm sorry, what?
Zoho.
Yeah. Yeah, I tried them out. They're pretty good. I think it's not as user friendly.
$10 per month.
Yeah.
They have very good integration with other things like marketing, CRM.
Yes. So Zoho Books. If you're planning on growing your business rapidly, you might want to look at Zoho Books because it allows you to start simple and move up. But you will probably have to hire a developer to help you. But you can build it out. QuickBooks Online has many add-on features, add-on apps. FreshBooks has what's called integrations. So there's sort of a limited way that different add-ons can communicate under the underlying software, and it'll do stuff when you're not online. It'll do it kind of in the background on their servers. But it's really another type of add-in. And then features are added frequently. So with these online services, as opposed to the old days where you had desktop, and QuickBooks still does offer that, these features are updated literally daily. Now, a lot of those changes are just bug fixes, which is sometimes be frustrating, but they will add features. Now, whether or not you need the features and whether or not you like them or it works is a different story. QuickBooks tends to force new things on you, and you have to opt out. So one day you log in and you're doing your deposits, and you're like, wait, this isn't the deposit screen. It says, try our new screen. And you're like, I hate this. And usually you can click a button and go back to it, but it does get annoying sometimes. But if you want yourself and maybe one employee, no inventory, and you kind of perform the same service for everybody, any one of these will work. And quite honestly, if you have less than a couple transactions a month, just use Excel, right? Because there's overhead involved in learning how to use this, using it, closing the books, right? I would say if you have more than 5 to 10 transactions a month, meaning revenue or pay, you should probably get a software package. Because by the end of the year, it's 120 transactions. And unless you're an accountant, at the end of the year, you might be able to get through it, but it's going to be really frustrating. Right. And it's probably better time you can spend on your business.
Yeah, I agree with that.
Yeah. The last thing on small business accounting software, very, very, very difficult for, and you could probably imagine why, to convert data. Because obviously, if you can just sign up for any software anywhere at any time, and there's no barrier to switching, well, what's to stop you? Well, the way they try to stop you, and I guess I can't blame them, is they make it hard to convert. Not saying you can't do it, it's going to take longer than you think. If you have more than one legal entity, seriously consider a costlier software package. There's something called Intact, and that has an add-on feature for multi-company. If from the start you're pretty sure you're going to have multiple companies, do yourself a favor, spend the money, write the check. It's going to hurt, but get more expensive software. So Intact is one that's online. INTAACT. The base package is $300 a month, so it's 10 times the cost. But I can guarantee you will save yourself the money in accounting fees. Intercompany accounting, just like partnership tax law, it was written by the devil. It is really complicated. Even seasoned account, I used to do it for a living, and I still have a hard time with it. Intercompany accounting, you cannot do it unless you know what you're doing. So do yourself a favor and pay the money out of the gate. There is limited ability to export to Excel or Google Sheets, but I would only do that if you're just analyzing. Don't do your accounting on it, again, unless you have really, really few transactions. Other features, and this is probably, I would say, the most important in terms of how you touch your customers. Most of these invoices are very rigid. In other words, QuickBooks does have some ability to customize, but very few of them have features to add, wraps or logos or special subtotals. If that's really important to your customers, you should really spend a lot of time on testing the invoicing, because that's an important touch point for your customer. You're saying, here's my logo, here's the money, you owe me, and you don't want to tick them off when you get that invoice, right? So if your business relies on complex invoicing, you should probably think of another way to do it, right? Don't expect the software to be really flexible. The trade-off to all this stuff, it's highly inflexible, because you're one of hundreds of thousands of users, and there's these servers that are lighting up somewhere in California and Texas and Hong Kong, right? They're all over the world. They're built for the mass market, and they're extremely rigid. So there's virtually no way you can customize them. They have limited functionality. You can add a field here or there. In QuickBooks, they have a dashboard. You can click this off or click on, but there's literally no capability to customize. Zoho, which you had mentioned, is a little bit different, but it does take time. It does take money. You have to know what you're doing.
The different codes, like.
So that's all I got.